Hello everyone, welcome to Finance by Avisha and Arpita. In today's video, we'll see multiple candlesticks pattern part 2. Part 1 has already been uploaded, so you can probably go and watch that video first. So the topic for today's video is the Harami pattern. Before you get thinking the word Harami does not mean for the word Harami used in Hindi. Apparently, it is the old Japanese word for pregnant. You'd appreciate the intuitiveness of this word when you see the candlestick formation. Harami is a two candle pattern. The first candle is usually long and the second candle has a small body. The second candle is generally opposite in color to the first candle. On the appearance of the Harami pattern, a trend reversal is possible. There are two types of Harami pattern, the Bullish Harami and the Bearish Harami. Coming to the first one, the Bullish Harami, as the name suggests, the Bullish Harami is a bullish pattern which appears at the bottom end of the chart. The Bullish Harami pattern evolves over a 2-day period, similar to the engulfing pattern. You can see here the chart of the Bullish Harami pattern is encircled. The thought process behind a Bullish Harami pattern is as follows. The market is in a downward pushing the price lower, giving the bears absolute control over the market. On day 1 of the pattern P1, a red candle with a new low is formed, reinforcing the bear's position in the market. On day 2 of the pattern P2, the market opens at a price higher than previous day close. On seeing a high opening price, the bears panic as they would have otherwise expected a lower opening price. The market gains strength on P2 and manages to close on a positive note, thus forming a blue candle. However, P2 closing is just below the previous day P1 open price. The price action on P2 creates a small blue candle which appears contained pregnant within P1's long red candle. The small blue candle on a standalone basis looks harmless, but what really causes the panic is that the bullish candle appears suddenly when it is least expected. The blue candle does not encourages the bull to build long position but also unnerves the bears. The expectation is that panic amongst the bears will spread faster, giving a greater push to bulls. This trend to push the price higher, hence one should look at going long on the stock. The trend set for Bullish Harami is as follows. The idea is to go long on the Bullish Harami formation. Price takers can initiate a long trade around the close of P2 candle. Risk takers can validate the following condition to confirm if P1 and P2 together form a Bullish Harami pattern. The opening on P2 should be higher than the close of P1. The current price at 3:20 p.m. on P2 should be less than P1's opening price. If both these conditions are satisfied, one can conclude that both P1 and P2 form a Bullish Harami pattern. The risk averse can initiate a long trade at the close of the date after P2 only after confirming that date is forming a blue candle. The least low of the pattern will be the stop loss for the trade. Here is a chart of Axis Bank. A bullish Harami is encircled below. The OHLC details for the pattern are P1 open 868, high 874, low 810 and close 815. P2 open 824, high 847, low 818 and close 835. This risk taker would initiate the long position as the close of P2, which is around 835. The stop loss for the trade would be the least price between P1 and P2, which in this case it is 810. The risk averse will initiate the trade the day near the close of the day after P2, provided it is the blue candle day, which is this case is once the trade has been initiated, the trader can will have to wait for either the target to be hit or the stop loss to be triggered. Here is another chart where the encircled candle depicts a bullish Harami pattern, but it is not. The prior trend should be bearish, but in this case the prior is utmost flat, which prevents us from classifying this candle pattern as bullish Harami pattern. And another example where a bullish Harami occurred but the stop loss for the trader triggered a loss. The bearish Harami. This is the third part. Now we'll come to the bearish Harami. The bearish Harami patterns at the top end of an uptrend, allowing the trader to initiate a short position. You can have a look at this chart. This shows a bearish Harami. The thought process behind sorting a bearish Harami is the market is in uptrend, placing the bulls in absolute control. On P1, the market trades higher and makes a new high and closes positively, forming a blue candle day. The trading pattern reconfirms bulls' dominance in the market. On P2, the market unexpectedly opens low, displaces the bulls and set in a bit of panic to bulls. The market continues to trade lower to an extent where it manages to close negatively, forming a red candle day. The unexpected negative drift in the market causes panic, making the bull to unbind their position. The expectation is that this negative drift is likely to continue, and therefore one should look at setting up a short trade. The trade setup for short trade based on bearish Harami is the risk taker will short the market near the close of P2 after ensuring P1 and P2 together form a bearish Harami. To evaluate this, two conditions must be satisfied. The open price of P2 should be lower than close price of P1. The close price of P2 should be greater than the open price of P1. The risk averse will short the market the day after P2 after ensuring it forms a red candle day. The highest high between P1 and P2 act as the stop loss for the trade. Here is the chart of IDFC Limited where the bearish Harami is identified. The OHLC details are P1 open 124, high 129, low 122, close 127. P2 open 126.9, high 129.70, low 125, close 124.80. The risk taker will initiate this trade on day 2 near the closing price of 125. The risk averse will initiate the trade on the day after P2 only after ensuring it forms a red candle day. In the above example, the risk averse would have avoided the trade completely. The stop loss for the trade would have been highest high between P1 and P2. In this case, it will be 129.70. So key takeaways of this chapter are the Harami pattern evolves over two trading sessions, P1 and P2. Day 1 on the pattern of the pattern forms a long candle, and day 2 P2 of the pattern forms a small candle which appears as if it has been tucked inside the P1's long candle. A bullish Harami pattern is formed at the low end of a downtrend. P1 is a long red candle and P2 is a small blue candle. The idea is to initiate a long trade near the close of P2. A risk averse trader will initiate the long trade near the close of the day after P2 only after ensuring it forms a blue candle day. The stop loss on bullish Harami pattern is the lowest low price between P1 and P2. The bearish Harami pattern is formed at top end of an uptrend. P1 is the long blue candle, P2 is a small red candle. The idea is to initiate a small trade near the close of P2. Risk takers, the risk averse will initiate a short near the day's close only after ensuring it is a red candle day. The stop loss on bearish Harami pattern is the highest high price between P1 and P2. So this is all about the multiple candlesticks pattern, and we covered Harami pattern. So if you gain a lot of knowledge, you may share it with your friends, subscribe to the channel, like this video. Thanks for watching. Bye bye.